futures are down about 31 points on the S&P 500, declining by 0.75%. The Nasdaq 100 getting hit just a little bit harder. That's the story on the S&P 500. Let's turn to the broader story across asset. You've seen the move in the bond market. Break-evens breaking out. Break-evens effectively the nominal minus the real. Right now, the nominal is breaking out by about 4 basis points on a 10-year to 166. You'll recall that the high of the trading range over the last couple of months is about 174 back at the end of March. Right now, about 166. In the FX market, euro a bit weaker. Euro dollar coming down to 120.11. Dollar yen breaking out. Bit of dollar strength off the back of those higher yields. And talking about inflation, crude right now, 65.72, advancing about 0.7%. That's the price action. Let's get you some morning calls. First up, a call coming from Berenberg, upgrading DraftKings to a hold with a 42 to 50 price target. The analysts seeing limited downside after shedding 40% from its record high back in March. That stock is down 1.45%. Your second call from RBC, downgrading Dollar General to Sexta Perform. The analysts expecting a challenging environment with inflation boosting food and gasoline prices. That's down 1.83%. And I had a feeling that my producer might do this. JP Morgan downgrading Faro to underweight after agreeing to be acquired by Prince International. The analysts seeing minimal upside given the company's inconsistent cash flow. Interesting choice of words there. Coming up, stocks looking less and less attractive relative to bonds. That conversation still ahead with bond yields breaking out and inflation expectations picking up off the back of a big upside surprise on your equity market. BTIG, Julian Emmanuel and Jack Caffrey at JP Morgan joining us on the other side. 4 minutes away, futures negative on the S&P 500. We break down just a little bit lower, down 31 with negative 0.75% at 41.14. This is Bloomberg. about you were looking for a 3 handle, you got a 4 on inflation in America. This is what it means for the equity market. Down 0.7% on the S&P. On a NASDAQ, off by 1.6% and negative 213. There's the opening bell. Switch up the board into the bond market. If you were looking for a lift in Treasury yields, here it is, up 4 basis points to 166. Across the Atlantic, go to Germany, your 10-year Bund. Negative 14 basis points, levels we haven't seen since spring of 2019. Euro dollar is lower. We break 121. Euro 120.94 against the dollar, down 0.4%. And crude did have a 66 handle a little bit earlier. It's still firmer higher, up 0.9%, 65.84. That's the cross-asset story at the market desk with your movers. Here's Abby.
Well, it's another brutal day for tech stocks, John. Clearly with that NASDAQ 100 underperforming below its 100-day moving average, breaking down, quite frankly. The sellers truly moving in on this blowout inflation print, that hot CPI. If we take a look at some of the movers beneath the surface, Apple, one of the biggest tech waiting to the NASDAQ 100, down for a third day. 200-day moving average. If it goes below the 200-day moving average, the long-term buyers are out. That tells you the sellers are very serious. It'll be the first time it will have happened since last year. Microsoft, Amazon, Alphabet, all of these companies put out great quarters. Clearly, the selling that we've been seeing more recently reflects these concerns around inflation. If we take a look at a chart from Tesla back from the beginning of January, we're going to see the degree of the skittishness, the bearishness, quite frankly, around these momentum stocks, the stocks that went so far so fast, that high valuation that gets pressured by rising inflation. This stock clearly deeply in a bear market. But where we do have some green, John, it is the banks. The big banks are higher. Yields up. In fact, take a look at Bank of America, Wells Fargo, both up more than 2%. So we have a little bit of a reprieve for some of those cyclical sectors, but tech really under pressure once again.
Yeah, the market under pressure more broadly at the headline level. Abby doing a great job of going through the sector composition, top of the pile, the financials, energy in the mix, fairly intuitive. Unlike yesterday when they were the two sectors at the bottom of the pile, right now information technology has that one. IT down by about 1.3%. The broader market, 500 off by about 0.6%. Going into the inflation number, this was the take of Mike Wilson of Morgan Stanley. He said the following: the equity risk premium is at the very low end of its range. It's underpricing cost supply issues as well as other risks. Bloomberg's Kelly Lyons has more. Hey, Kaylee.
Hey, John. Well, equities losing just a bit of their luster, and that is true once again after that upside surprise on the inflation data this morning. On the back of that, equities, of course, are lower, led lower by the NASDAQ 100 down 1.4% as we see Treasury yields ticking higher. We're now up the better part of 5 basis points on the 10-year yield, sitting at 1.67%. And John, of course, the higher yields climb, the more relatively attractive they become versus stocks. That equity risk premium is shrinking. That extra compensation you get for holding the S&P 500 around its lowest since 2007. We're talking 14 years. When you look at the spread between the forward earnings yield on the S&P and that of the 10-year Treasury yield, right now we're sitting at just 277 basis points. Compare that to the average of 384 basis points since the global financial crisis. So if we see that risk premium revert to the mean, that could mean the S&P 500 needs to go down to below 3,400. That could be a correction of 20%. That's for the broader equity market. And then when we look at the sectors that could be most vulnerable, well, it is the likes that have the lowest forward earnings yield, the likes of real estate, discretionary, industrials at the bottom of the barrel. That 2% forward earnings yield on real estate is only around 33 basis points above where the 10-year Treasury yield sits this morning. And then on the other side of that rate sensitivity spectrum, you do have the financials that look most insulated here, that forward earnings yield of 6.8%, John.
Kaylee, thank you. Some comments from Richard Clarendon, the Fed Vice Chair, saying the following this morning: we have pent-up demand in the economy. It may take some time to supply to rise up to the level of demand. We've seen example after example of that. We saw it in the payrolls report. Now you see the price pressure this morning too. Let's bring in BTIG's Julian Emmanuel, Jack Caffrey at JP Morgan Asset Management with us too. Julian, let's just start right here. Your reaction to the number that dropped 60 minutes ago.
Well, obviously a huge number, but what it really points out, John, is that, we've been saying this is not your mother's economy anymore, it's your grandmother's. So the great moderation that we had, where with small exceptions, obviously the financial crisis, but for years and years, we floated either side of 2% GDP growth. We have to get used to the fact that economists no longer have the tools they need to predict what's going on in this economy, both